The United States and China are engaged in critical trade negotiations in Switzerland, aiming to address the ongoing tariff dispute that has significantly impacted global economic stability. The talks, involving U.S. Treasury Secretary Scott Bessent, U.S. Trade Representative Jameson Greer, and China's Vice Premier He Lifeng, come amid heightened tensions following President Donald Trump's imposition of substantial tariffs on Chinese goods, with some duties reaching as high as 245%. In response, China has levied retaliatory tariffs of up to 125% on U.S. products. President Trump has suggested an 80% tariff rate, down from current levels, contingent on reciprocal concessions from China. These discussions are crucial for reshaping trade practices between the world's two largest economies and could profoundly influence international trade dynamics and investor sentiment. The uncertainty surrounding the outcome of these talks has led to volatility in financial markets, with the Dow Jones Industrial Average, S&P 500, and NASDAQ Composite showing slight declines as investors adopt a cautious stance. Despite a strong earnings season, where 76% of S&P 500 companies exceeded expectations, many businesses have adjusted or withdrawn their earnings forecasts due to the trade tensions. The Federal Reserve is closely monitoring the economic impact of these tariffs, with Richmond Fed President Tom Barkin expressing concerns over reduced business investment and hiring. This situation presents a challenge for the Fed, as it balances potential inflationary pressures against the risk of an economic slowdown. In the broader context, the U.S. China trade conflict has strained financial ties, with new U.S. investment regulations complicating engagements and potentially leading to the delisting of nearly 300 Chinese firms from U.S. exchanges. The erosion of trust and the imposition of tariffs are disrupting trade flows and increasing economic uncertainty. Meanwhile, the U.S.-UK trade agreement, though lacking detailed provisions, aims to enhance market access for American agricultural products and British automobiles and steel, signaling the U.S. willingness to negotiate sector-specific relief. As the U.S. and China continue their discussions, global markets remain poised for potential volatility, with significant implications for currency movements, safe haven asset flows, and overall economic performance.
The United States is approaching its debt ceiling with a reasonable probability of hitting the $36 trillion limit in August 2025, according to Treasury Secretary Scott Bessent. This situation arises as Congress is set to be in recess, prompting Bessent to urge lawmakers to act swiftly to prevent a potential government default. The Treasury Department has been employing extraordinary measures since January to manage the existing cap, but these are temporary solutions. The Republican-controlled Congress is engaged in discussions to increase the borrowing limit as part of a larger tax and spend legislative package aligned with President Donald Trump's policy priorities. However, these negotiations have yet to yield a viable legislative outcome. The potential failure to raise or suspend the debt ceiling poses significant risks to the financial markets, businesses, and the federal government. As highlighted by Bessent, a default could undermine the United States' financial stability and diminish its global leadership and security standing. Historically, delays in addressing the debt ceiling have led to market volatility and uncertainty, emphasizing the need for timely legislative action. The Treasury Secretary's call to action reflects the urgency of the situation, urging Congress to address the issue before its scheduled break in mid-July to maintain the nation's creditworthiness.
The U.S. travel industry is showing signs of a slowdown as key players report declining demand ahead of the summer season. Expedia Group, which operates platforms such as Hotels.com and VRBO, reported weaker than expected revenue growth of 3% for the first quarter, missing Wall Street expectations. The company attributed this to a 7% decline in bookings into the U.S., with a particularly sharp 30% drop from Canada. Similarly, Airbnb and Hilton have noted a reduction in both domestic and international travel to the U.S., aligning with a broader trend observed by major airlines, which have retracted their full-year financial guidance due to a decrease in leisure travel bookings. Economic uncertainty and geopolitical factors, such as the impact of tariffs imposed by President Donald Trump, are influencing consumer behavior. The U.S. Travel Association suggests that these factors, combined with a decline in consumer confidence, are contributing to the reduced travel demand. Bank of America data supports this, indicating a shift in consumer spending away from high-cost discretionary items like airfare and lodging in favor of more affordable experiences such as dining out. This shift in consumer behavior could have broader implications for the U.S. economy, potentially impacting related sectors such as hospitality and retail, and influencing market sentiment as the travel industry adjusts its strategies to navigate these challenges.
Sumitomo Mitsui Banking Corporation, SMBC, a unit of Japan's Sumitomo Mitsui Financial Group, has announced its agreement to purchase a 20% stake in India's Yes Bank for approximately 135 billion rupees, $1.58 billion. This acquisition marks the largest foreign investment in India's banking sector to date and underscores the ongoing trend of Japanese financial institutions expanding their presence in India, the world's most populous country. SMBC will acquire shares from the State Bank of India and other investors at a price of about 21.50 rupees per share, positioning itself as the top shareholder of Yes Bank. Following the initial reports of SMBC's interest, Yes Bank's stock saw a notable increase, last trading at 20.02 rupees on the Mumbai exchange. This strategic move by SMBC reflects the growing appeal of India's $4 trillion economy, which is perceived as more resilient to global economic downturns compared to other nations. Additionally, the ongoing U.S. China trade tensions have positioned India as an attractive alternative manufacturing hub, further enhancing its allure to foreign investors. The investment by SMBC not only strengthens its foothold in the Indian market, but also signals confidence in India's economic prospects amid shifting global trade dynamics.
NAPCO Security Technologies Incorporated, NASDAQ GS NSCC, is under investigation by Conn Swick & Fody LLC, led by former Louisiana Attorney General Charles C. Fody Jr. This investigation follows NAPCO's disclosure of significant financial reporting weaknesses for the first 3 quarters of fiscal 2023. The company admitted to errors in calculating the cost of goods sold, COGS, and inventory, leading to overstated inventories, gross profit, operating income, and net income. Specifically, net income was overstated by up to 114.97%, with similar discrepancies in income per share, operating income, and gross margins. These revelations have resulted in a securities class action lawsuit, which has progressed as the court recently denied NAPCO's motion to dismiss. The ongoing investigation by KSF is scrutinizing whether NAPCO's officers and directors violated their fiduciary duties or state and federal laws. This situation has significant implications for NAPCO's shareholders, as the financial misstatements have likely affected the company's stock performance and market perception. For investors and stakeholders, the outcome of this investigation and the class action lawsuit could influence NAPCO's future governance and financial practices, potentially impacting investor confidence and the company's market valuation.
A class action lawsuit has been filed against Viatris Inc., with Conn Swick & Fody LLC representing affected investors. The lawsuit alleges that Viatris and certain executives failed to disclose critical information, violating federal securities laws. This legal action follows the company's announcement of disappointing fiscal 2025 guidance, attributed to issues at its indoor facility, which led to a significant drop in the company's stock price from $11.24 to $9.53 per share. Investors who purchased Viatris securities between August 8, 2024 and February 26, 2025 are encouraged to consider their legal options, with a lead plaintiff deadline set for June 3, 2025. The implications of this lawsuit are significant for Viatris, as it highlights potential vulnerabilities in the company's operational and disclosure practices. The drop in stock price reflects market concerns over Viatris's financial health and governance, potentially affecting investor confidence and future capital-raising efforts. The outcome of this lawsuit could influence Viatris's strategic direction and operational transparency, impacting its market position and shareholder value. Investors and market analysts will closely monitor the developments of this case for further insights into corporate accountability and compliance within the pharmaceutical sector.
Tesla Inc. is positioned to benefit from new legislative developments in Texas, where lawmakers have passed bills that could limit the influence of small shareholders over corporations. Senate Bill 29 and Senate Bill 1057, awaiting Governor Greg Abbott's approval, aim to make it more challenging for shareholders to initiate lawsuits and propose resolutions at annual meetings. This legislation comes in the wake of Tesla's legal battles in Delaware, where a court recently overturned CEO Elon Musk's pay package. The move, dubbed Dexit by supporters like Senator Brian Hughes, reflects a broader trend of companies seeking alternatives to Delaware's traditionally dominant corporate governance framework. The potential impact of these bills is significant for Texas-incorporated companies such as Tesla and Southwest Airlines, as well as businesses headquartered in the state. Support from major entities like AT&T, NASDAQ, and the Texas Stock Exchange underscores the bill's potential to reshape the corporate landscape in Texas. The legislation was partly inspired by the influence of activist investors, exemplified by hedge fund Engine No. 1's successful campaign to alter ExxonMobil's board in 2021. If enacted, these changes could enhance Texas's appeal as a corporate hub, especially for companies looking to minimize shareholder litigation risks and bolster strategic autonomy.
Global egg prices have experienced significant volatility in recent years, driven by factors such as avian flu outbreaks, rising feed, fuel, and labor costs. In the United States, egg prices surged by 238% over 4 years, peaking at over $8 per dozen during the end of the Biden administration. This spike was largely attributed to supply chain disruptions and avian flu, which severely impacted production. However, a recent shift in U.S. policy under President Trump has seen prices fall below $4 per dozen, indicating a potential stabilization of the market. Globally, Switzerland emerges as the most expensive country for eggs, with prices reaching $7.31 per dozen, nearly double that of neighboring Italy. Conversely, emerging markets like India offer the most affordable prices at 97 cents per dozen, highlighting the disparity in food costs across different economies. This price variation underscores the broader economic challenges of inflation and supply chain issues affecting staple goods worldwide. As the demand for affordable protein continues to rise, understanding these price dynamics is crucial for policymakers and consumers alike, particularly in balancing affordability and sustainability in food production.
The recent revelation of the Gaza Humanitarian Foundation's GHF plan to manage aid distribution in Gaza has stirred controversy among international aid organizations and political observers. The GHF, a nonprofit registered in Switzerland, is poised to oversee humanitarian operations in Gaza through a new framework that emphasizes security and transparency. The plan involves the establishment of secure distribution sites for delivering meals, hygiene kits, and medical supplies to the Palestinian population, with the aid being transported via armored vehicles to prevent diversion. This initiative is backed by a mix of American executives and financial experts, including former leaders from World Central Kitchen and MasterCard, and is supported by U.S.-based financial institutions like Truist Bank and J.P. Morgan Chase. The plan, however, has faced criticism and rejection from UN agencies and other international aid organizations, which are reportedly under pressure from the U.S. government to participate. Concerns have been raised about the potential for the GHF's operations to inadvertently contribute to international crimes, as highlighted by Amnesty Switzerland. Moreover, the Foundation's strategy has been perceived as a shift from traditional aid models, with some pro-Palestinian advocates warning of a U.S.-controlled aid scheme that might undermine existing international efforts like those of UNRWA. The GHF aims to restore donor confidence through a rigorously audited model, promising that every dollar will be traceable. but the broader implications of this approach on the humanitarian landscape in Gaza remain contentious.
The California Association of Realtors, CAR, reported that housing affordability in California remains critically low, with only 17% of the state's households able to afford a median-priced, single-family home in the first quarter of 2025. This figure represents a slight increase from the previous quarter, but remains unchanged from the same period last year. In San Diego County, for example, a household must earn at least $266,800 annually to purchase a median-priced home at $1.03 million, with only 12% of residents meeting this threshold. Comparatively, in Los Angeles County, the required income is $222,000 for an $862,570 home, while Orange County demands $373,200 for a $1.45 million property. The most affordable region, Imperial County, still requires an annual income of $103,000 for a $399,000 home. The report highlights the broader economic challenges faced by California's housing market, as mortgage rates have surged to their highest levels in 3 quarters amidst growing economic uncertainty. While the monthly mortgage payment for a median-priced home slightly decreased by 1.8% from the end of 2024, it increased by 4.6% year over year. The Federal Reserve's decision to hold interest rates steady reflects ongoing concerns over economic volatility, which may continue to impact mortgage rates in the coming months. In contrast to California, 37% of U.S. households can afford a median-priced home, requiring a significantly lower annual income of $103,600. This disparity underscores the unique affordability challenges facing California's real estate market.